Hello and welcome to today's episode of On the Mark Financial Literacy with Mark Zinman. Good morning, Alicia, and good morning, Mark.
Good morning. We're all together today in the same place. We're not remote.
We might be able to get Alicia to say hi then, since we're here.
Good morning.
Mark, today we're talking about early savings for education and then student loan debt management. Yeah?
Yep. Looking forward to it. Exciting topic.
It is an exciting topic, and it's one that is relevant to a lot of people today and poses great concern for a lot of graduates who have some student debt.
And it has a lot of financial literacy, especially on the financial literacy on both ends, paying the student loan debt off, as well as how to save for school or your children.
Absolutely, absolutely. Okay, so let's dig in. There are a couple different options here as we think about early savings for education. Let's start with the low-hanging fruit 529 plans. What can you tell us about tax advantages, contribution limits, flexibility, impact upon financial aid?
529 has been around for a while, and just so you know, like 529, 401k, they actually refer to code sections in the IRS code. So 529 is code section 529. 529 plans have evolved over the years, and they're much more flexible now than they were 20 years ago. I have a passion for 529s because that's what I use to help assist us put my children through school. My oldest is 37, so she's been out of school for almost 20 years. So this goes back 30 years ago when we started it. 529s are an answer to one of those things we've talked about in other episodes. One is, how do you satisfy all your financial obligations on perhaps a limited amount of money? And a 529 or any of the other items we might talk about is going to be part of what you may budget. My story about a 529 is, when my children were young, I've said in earlier episodes, and it's part of what I say, is that nobody has made enough money in order to fund their life. Everything went out, vacations, a house, a kid. Nobody has that kind of money unless you're somehow, a billionaire. And we don't have many billionaires in our practice or in our lives or our friends. So the way that parents can sleep at night is to feel like they are doing something and they're not ignoring that. So getting life insurance when a child is young to make sure you're insuring for the economic loss of that person. We talked about that, and 529 is another one.
Insuring the parents, not the children.
Yeah.
Insuring not your liabilities.
Insurance to make sure that you take care of your children if something happens to you. And obviously we're insuring your income in that case. But 529 is another one. So my story about a 529 is that when my children were born, I started putting, I think it was either $50 or $100 per month per child, and it paid for approximately 50% of my children's education, which is a large percentage when you consider how much school is. So if school was $40,000 a year, I saved $20,000. And it's a lot easier to climb that delta, 40 versus 20, when you're in your 40s or 50s when your children are in school, as opposed to in your 20s and 30s when you have those children. It earns money tax deferred. There is no tax deduction on the federal level for 529s. There can be for certain states. Pennsylvania happens to be one of them. You can deduct $14,000 per year per child. Other state rules change, but it earns tax deferred, and it's sort of like a Roth. Think of it, if you know anything about a Roth. So basically, you put the money in, if you use it for the specific purpose or hold it long enough, like in a Roth, you have to hold it for 5 years, you have to meet retirement. In a 529, if you hold it, there's no holding period, but you put it in and use it for the proper things, the income's never taxable. And they have expanded 529s more recently so that you can cover some of the expenses of K through 12. It's not as broad, like it's tuition. It's not as broad as like college, which is everything. But the limit's $10,000. So the reason why it's not that of a concern is that the tuition alone could be $10,000 in some type of a K through 12 private school. And so if you can't get beyond if the tuition's 12 and you use 10, there's not extra money anyway for supplies and equipment and other things that child may need that you're going to have to pay outside the 529 anyway. The downside of that is that the longer you keep the money in the 529, the more it compounds. So, if you keep the 529 for years, you could have more money in earnings than you can in principal. And I'll give even a more recent example. A more recent example, I have 2 grandchildren. And so, and this is maybe addressing to some of our older listeners. Children do not wait or want money from a parent when they die. It's not like, oh, when mom goes, we'll be able to buy that shore house. I don't think that there are many children that speak that way. And there's money that parents want their children to have. And that's sort of like a little bit of a dichotomy in a mismatch of values. But one of the things that I think that a grandparent can do is help pay for school for their grandchildren, because I think that that's something that's appreciated by the child, because it's not a direct benefit to them, but a direct benefit to somebody in the family. So we started, I have a 4-year-old granddaughter and a 2.5-year-old grandson, and for both of them we started a 529 when they were born. My grandson, who's going to be 3 in January, he's probably around $10,000 now, putting $100 a month in and $2,500 each birthday. So you can see it was only 2, so I put in 5 and $100 for 24 months, so I've made 25% return, and that's just because that's what the market is. And I have a great story to tell, if I can digress. My story to tell is that I said that I did 529s with my children, and one of the vehicles I used, there was a credit card out called a You Promise credit card. I don't know if it still exists, but the reward on that credit card is they put 1% of whatever you paid into a 529. Okay? So we had one for our oldest daughter, and I completely forgot about it and didn't spend it. So my best friend had his granddaughter, I think she's 7 now, and I said my oldest is 4, so I had grandpop fever. Okay, I was very jealous and envious that he had a grandchild. It's just very exciting to those out there that are new grandparents. That's sort of like, I always say, like, if we could just skip the kids and go to the grandkids, life would have been great, right? But anyway, so we were at lunch, and at this time, my daughter was married. My oldest daughter was married, my son was dating, and my youngest daughter wasn't dating anyone at the time. We were at brunch, and I said to the kids, I said, listen, our friend Michael, he had a grandchild. I really want a grandchild, and I have a bounty. And they said, what's your bounty? I said, well, Mom and I discovered that we have $6,000 of an unused 529. It goes to the first person who gives me a grandchild. And my oldest daughter said, Dad, we're not sure if we want to have kids. And my middle son said, well, we're just dating. And my youngest daughter said, well, I'm not even dating anyone. I said, listen, when you're 17 and you're pregnant, maybe you got to look at the parents. 24, you're on your own, baby. You want the money? You'll get out there. And the kids laughed. So the winner was my son. They got and that is another, alluding to another benefit of a 529, is that you can pass it from child to child. Yes. And yeah, one of the concerns that people have about 529s is, how do I know my kid's going to go to college? How do I know my kid's going to be this, that? How do I not underfund it, overfund it? I will tell you that it's almost impossible to overfund a 529. It's very possible to underfund. So I wouldn't worry about overfunding, and especially in a family where you anticipate having more than one child. If you fund the oldest first, then you can always move the money. In my situation, I moved it from generation to generation. So you don't have to use it, lose it, and then have a tax benefit. And if you take the money out of a 529, there's a tax on the earnings if you take it out for a purpose and a 10% penalty, just like there sort of is with a retirement plan.
Don't go anywhere. We'll be right back after a quick break from today's sponsor.
Looking for smarter employee benefits without the hassle? Apex Benefit Group has your back. With over 35 years of experience and clients in all 50 states, we design custom insurance and benefits solutions that actually work for businesses of all sizes. From health and dental to life, disability, and retirement planning, Apex helps you take care of your team while saving time and money. Ready to make benefits simple? Visit apexbenefitgroup.com or call 215-795-0509 and see what real support looks like.
And segueing into financial aid, we had said we would discuss the impact upon financial aid. So the funds in the 529, until they are used, is considered an asset of the parent.
That is correct. So it doesn't count against the child, yeah.
Okay, so huge fan of a 529 plan, less so for a Coverdell education savings plan.
Yeah, the Coverdell, so again, There are some, you can put a lot of money in a 529. We talked about the limits for what may be deductible in Pennsylvania, but you can put in up to the gift amount, which I believe right now is $18,000. And in a 529, you can pre-fund it. You can do 5 years at one time without having gift tax consequences. Okay, I mean you just front load it. You can do 5 at one time and then nothing for the next 4 years. It's not like 5 and whatever, but you can do 5. I do not have anyone that I recently can even remember wanting to put that large of a sum in. Usually, if it's a larger sum, it could be around that $10,000 to $15,000 range, and that's still rare. Most people, it's just like I discussed. It's going to be a monthly amount. And maybe an extra for a birthday or some other kind of thing that makes you do more. Maybe you start at 50 and then the next year you do. It's sort of like the same thing we talk about with a 401k. Get into it and then push it every year a little bit. It doesn't have to be $10, $15 a month. Whatever you can afford, you'll feel better about what you're doing. And with the Coverdell, there's 2 issues with it. One is that it has a limitation. It's only $2,000 a year, and so. If I'm a fan of a 529, I don't know there's any better tax benefit in a Coverdell, so I would, if I'm not fully funding one, then I wouldn't get to the conversation of a Coverdell. The other problem with a Coverdell is there is an income limit where there is no income. When I say income limit, a lot of these things we've talked about in tax, they have phase-out periods. This has a phase-out period, a 529 doesn't. So it's not so much that I'm anti-Coverdell, it's that in the planning and stacking, a 529 would stack in front of a Coverdell.
All right, Uniform Gifts to Minors Act and Uniform Transfers to Minors Act. Flexibility, taxation control, what would you say about that?
Not my favorite, okay? So certainly if a child is given gifts or monetary gifts on birth or whatever, that would go into gift under minors. And we're not usually talking about a significantly material amount of money, but I do get questions from parents like, why wouldn't it be better if Johnny's not going to go, if I don't know what's going to happen to Johnny and he's 2 years old, is it better to just put it into a gift under minors act account so we can have more flexibility? And the answer would be the opposite. You have less flexibility. Why? 2 reasons. Number one is that depending on the maturity in your state, either 18 or 21, you lose control of those funds. In a 529, there is a beneficiary and a trustee. So the parent's a trustee, the child's a beneficiary, and the child doesn't have access to the money without the parent's permission, even after age 21. But in a Gift to Minors Act, they do. The other issue you have is you're going to pay taxes on that money, and that money will count against financial aid because it's an asset of the student and not an asset of the parents, and you just lose a lack of control. And the other problem is that people say, okay, well, I'm going to put money in a Gift to Minors Act account, and then later on, if I want to, I can move it to a 529. No, you can't. Why? Because in order for the money belongs to the child has to have the capacity to make a gift. A child under the age of maturity doesn't have the capacity legally to make a gift. So in essence, it's illegal to raid your child's Gift to Minors Act account, even if you think it's for their benefit, because you can't get permission from them. So it gets, now, how many parents are out there being sued and stuff? I don't know, but I'm just saying, like, just from a practical point of view of control. The other issue is when you have a child, you have hopes for that child, but you don't know what it's going to be. Are they Ivy League? Are they scholarship? Are they going to be athletic? Nobody knows. When the child gets into maybe 10 to 13 range, maybe you start to see their academic prowess. Maybe you start to see their what they want. They're out of being a cowboy or an Indian, and maybe they want to have an actual profession that is a job they can get in a metropolitan area. I'm sure you could be a cowboy out in the West, but as they mature, then you would refine. So in my guise of saying that it's very hard to overfund them, you're going to get to a certain level when they're 10, 12, 13, and it's not going to be enough to it's not going to be enough to put you into a position like that you can't get out of. So remember, a lot of times we recommend don't put yourself into a financial corner without choices. And this is one of those things. Don't put yourself in a financial choice. Having multiple children that you can spread it out over helps. Having a child that you're not sure what they're going to do, but it becomes more clear is going to help. And I just think that that fear is not a real one.
Would you consider it an advantage, however, that these custodial accounts that we're talking about now can be used for purposes other than education?
Yes, but most parents don't.
Gotcha.
Most parents don't. I mean, sometimes they'll, in essence, a child can't really own a bank account until they're at maturity. So even if you went to the bank and opened the account when they're 13 for their summer camp job or something, it really is still in a gift to minors, and the parent has to be on the account, even though it might not be titled that way. Yeah, if you're going to if they want them to save for a used car when they're 17 or something that's particular, yes, but not. We don't want a child to have access. So right now, the typical state school with room, board, tuition might be in the $30,000 to $40,000 range. A private one, 60 over, without any, any financial aid, scholarship, or whatever. So you're looking at $160,000 to fund 4 years of perhaps a state school, and maybe you have half, like I did. In today's dollars, that would be $80,000. You really want an 18-year-old for whom maturity and attitude and where they are isn't there, and have access to $80,000 when they're 18 or 20. It's more 18. 18 is a more popular maturity date than 21. But I just think that that's where the danger lies. And you can have the best kid in the world, and everything works out fine. But it's hard to predict something. So when we talked about it in another thing, risk, right? Risk is solved by time. Okay, so the more time you have, the less you can risk. So you have a child for 18 years. By not boxing yourself into a situation, you have the time to lay that risk. If you put it all into a Gift to Minors Act account and your child doesn't turn out the way you want, or doesn't do what you and your spouse may want them to do, then you're stuck because of your earlier choice.
So I think you're saying, in the context of what we're talking about right now, you're saying risk is mitigated by time and control, and at the time that your child reaches the age of majority, you lose control over those funds. I think
that is correct.
There we go.
That's correct. Now, we talked in an earlier episode about trust and stuff like that, but that's a different way, but that's more sophisticated. We're just talking about your basic, how do you start out saving, what's the best kind as we're raising. Yep.
All right, so let's segue now to some steps for managing student loan debt, and let's talk about strategy. So if we could, please, we want to make sure that if the parents heretofore were managing the student loan, the FAFSA applications, that everyone with student debt understands what payments are due, what those due dates are, what the principal balances are, what interest rates they're paying, know the repayment rules and the grace periods when you are no longer actively enrolled, a 6 months or a 9-month grace. And then there are some different strategies once you understand the landscape of what you're looking at that one might follow. So there are 3 different things that I hoped you might provide some guidance on. The first of the 3 is prioritization. So some school of thought, it varies, right? Do you prioritize the high interest loans? Do you pay off the small loans first to get them out of the way? Or do you look at loan consolidation? So on this first topic, what would you offer as advice?
So any debt that you have, and we could be talking about student loan debt specifically here, we could be talking about credit card debt. You certainly want to make your payments on a timely manner to keep your credit rating up. You would tend, in a world without any outside changes, to pay the highest rate off first. So if you were going to pay extra, then you would pay extra to whatever the highest is. We have talked about the fact that credit card debt is evil, and we should avoid it. So that is by far you shouldn't get into it, and if you somehow do, you got to get out of it. When it comes to student loan debt, it's more of a means to an end. You needed a loan in order to get to school. The cost of that is the interest rate or the payment you have to make, and so you have to manage that. And it's not, we talked about good debt and bad debt. That's, I would consider to be good debt because you got your degree out of it.
Okay. All right, now what about making extra payments to principal? Do you advise that?
Yes. So I think that it's important to try and get rid of student loan debt. It will affect you if you don't. Certainly it's counted. So any debt, we talked about about getting a mortgage or buying a house, that there's debt to equity ratios. It's 28. The typical rates is 28 to 36%, meaning that your home debt should not be more than 28% of your gross pay, and your total overall revolving debt shouldn't be more than 36%, and that's sort of the limits that these mortgage companies would look. And certainly, either the minimum payments on your credit cards, if you weren't paying them off, plus the debt service, meaning the monthly payment of principal and interest on each of these loans, count towards that 36%. And a car loan or something else you might have, which is still a valid debt, counts to that. So the faster you pay off the credit card debt, the better off you are to borrow money maybe for that home down the road. Within the bounds of your budget.
Yes.
Yeah. And so it's just, I mean, if you have extra money, the question is, do I want to, you think about it this way, cash is king, okay? So having the money in the bank gives you the choice to do something, but at the other, it's the cost. So I could pay off an 8% student loan, or I can gain 3.5% in the money market at my bank. Which is better? Well, it's better to get rid of the 8% loan, but you can't borrow back on the 8% loan. So you have to not make sure you don't back yourself in a corner. But the answer to your question is, to the best of your ability, keep that reserve, but also pay down the principal.
Okay. And when you are still enrolled in school, you can make interest-only payments on the student loan amount, or your parents could make those payments on behalf of the student. What is your advice and recommendation there?
In the most case, if you could pay the interest, then maybe you needed less of a school loan. So, I mean, unless mom and dad want to help you out or something, I mean, for the most part, again, it's cash flow. You're saving the compounding of the interest if you pay it. If you were able to do it, that's fine. I would say, if you're stacking up where you get your money for education, the student loan would sort of be the last one on that pile, because I have to backfill it in. So I guess it's going to, I don't have a problem with paying the interest. The question is, how many people would be able to pay the interest? They needed the loan in the first place, so did they have the cash to pay the interest? And one of the benefits is, as long as you're a full-time student, you don't have to make any payments.
And that's a good segue into possible areas where you could receive tuition reimbursement or forgiveness, both through a private employer or, we'll talk about the new administration and how that's changed through the federal government. But one strategy that some parents will follow, if they are lucky enough to have if they have the financial ability to pay for their children's college education, just as straight out of their account, right? Cash pay as you go. Some parents will instead take out student loans on behalf of their child, or have the child take out student loans, and will put that cash aside because they don't know what type of reimbursement opportunities will be available for their child once they become employed. So a strategy might be, I have the $40,000 to pay for this year's tuition, room and board fees, but I'm going to put it in a different account and wait until you graduate and see if your employer has some type of forgiveness program, because otherwise that opportunity would be lost.
And that's I think you agree, that's more of a recent phenomenon, that more, in order to attract people, employers are putting more emphasis on maybe some sort of support or payment of student loans.
I do agree with you. And so, you had alluded in the past that in addition to having the accounting firm, we also have an HR consulting and business advisory firm. And so these are some policies that we write for some of our clients. And I thought we might talk a little bit about the difference between a tuition reimbursement versus a forgiveness program as sponsored by a private employer. Would you like to speak to that? Would you like for me to add some content?
Go ahead. You're my HR guru.
Okay. So a reimbursement, if you are lucky enough to get hired by an employer that has a tuition reimbursement program, this might be where there is education that you could receive that would help you expand your skill sets in your role. So because it will help the employer, potentially thrive, they might be willing to reimburse. So you might pay your tuition and they might reimburse you so long as you, maintained a certain GPA. A forgiveness program is a little bit different. A forgiveness program is one where you might get hired, you're coming in with $100,000 worth of student debt, and the employer may say, we've hired you for this role, your degree, is aligned with the role and the task that you will be responsible and accountable for, and so I will make a payment to your loan provider on your behalf. So we, as in the field that we're in, when we write these policies, I'm a huge fan for being as inclusive as possible, all for the employee's choice of one or not the other, not take advantage of both. That would be potentially not really equitable to other team members, but if you're coming in with student debt, this is what we can do for you. If you're not coming in with student debt, but you would like to pursue further education, then this is what we can do for you. So I love writing policies that offers the employee's choice of forgiveness or reimbursement when those funds are available. You have to stay within limits or it will become a taxable event, but nonetheless.
And you're seeing those become more popular as an employee retention benefit?
As a tool that is used during recruitment and retention, yes, absolutely.
I just want to take a step back 1 second here. One of the discussions I have with parents a lot, especially early on, is what did they consider emancipation of their child. And we can go. I went to public school. Darn, my kid's going to go to public school. Somebody might say my kid went to a parochial school, a Catholic or a Jewish school, and I want them to have that same education. I paid for college, so the kid's going to have to pay for. There's all kinds of things, and I, as a consultant and an accountant, have conversations with clients like, what do you consider to be emancipation? The more common one is maybe paying for undergraduate degree. That would probably be, if I could possibly pay for an undergraduate degree for my child, that would be what I want. Sometimes that changes based on the fact that maybe somebody who's a little older have better financial means and the child wants to go on to graduate school, they would pay. But early on, that would maybe be the goal. And then you could backfill that goal. And to the extent that you're discussing all these other strategies, it's the same thing like risk reward. If I pay it off now, am I losing a benefit later? So one of those benefits could be an employer who has a reimbursement thing, but I believe the limit's like around $5,000 a year, $5,200 a year. I'm not going to.
I think it's $5,250.
Yeah, okay, $5,250. So even if you come in with $100,000 of student loan debt, which was your original example, $5,250 is about 19 or 18 years. So yeah, that would help, but you don't want to sit on 18 years worth of debt, not knowing what your future is going to be. So what's the risk reward there? The most common one I've seen is, because they tend to rack up the most student loan debt, is physicians that come out of school with a lot of debt. There are opportunities, depending on the type of hospital or setting or area that they work in, they may get some forgiveness or limitations of what the percentage of their monthly payroll can go to that. And this is kind of interesting because a lot of those doctors may get married while they're still paying their student loan debt off, and then it becomes an issue of, do I file jointly with my spouse, in which case my spouse's income will factor into whatever that percentage is, or do I do married filing separately, and I will save a certain amount of money in principal on my loan payment, or not principal, but back-end principal. But marrying and filing separately usually has a penalty as far as total family tax. So you have to say, well, I'm going to save $1,000 a month on the back end if I fulfill my public service or whatever program you're in, but it's going to cost me $500 a month in taxes. And I would say that most of the clients that have that opportunity do file separately and just pay the difference because it works out that way, but it's something you need to calculate. You can see that there's so many, when we talk about planning items, and we're talking about student loan debt, which is at the back end. We're talking about 529s, which is at the front end. There's so many choices, and you really need to map out what you are trying to achieve and then backfill those goals into what you can afford and maybe what the political climate will be over that period of time. It's just, and there's no certainty, right? Things change all the time, and when we're talking about 18 years from the birth of a child, that is a really long time. And a lot of these student loans have similarly long payouts, 10 years or longer they could be. And so you could be dealing with paying for student loan till you're in your 40s, right? You start out when your parents are born saving money, and you're still paying student loans into your 40s, depending on how you manage that. So it's pretty much a lifelong discussion and opportunity and risk.
Yes, yeah, and it might represent, the largest debt that, other than a mortgage or student loan. I mean, what else are we looking at that would be that high, other than your mortgage and your student loan debt, if you did complete several years of grad school specifically?
Right, and student loan debt will definitely have an effect on your ability to purchase a house.
Very valuable points, and it speaks to the importance of having a tax professional, and it also speaks to the importance of, in an earlier episode when we talked about the importance of budgeting, so you
And
understand.
flexibility. We keep talking about flexibility. Since we can't predict the future, you have to leave yourself in a position that you can take advantage of it without it being a detriment.
Okay. All super helpful information, Mark. Thank you for sharing your knowledge and expertise with us. If anyone has a question that they would like to pose about today's episode, or a question that they might like addressed as the topic for a future episode, we hope you will go to onthemark.cpa and submit your question there. Thank you so much, Alicia, and thank you so much, Mark, for your time today. We look forward to seeing you next Wednesday. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.